With some segments of the market taking it out in the chin so far in 2026, it's time to start looking at some values. And there's some really cheap stocks out there, companies that are buying back in excess of 10, 15% of their shares outstanding on an annualized basis, trading for single-digit price to earnings and price to free cash flow multiples. Yes, those values exist after the recent sell-off. So I want to go through three that I think are really attractive today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, Fiscal AI. I'm going to be using Fiscal AI throughout this video. It's a phenomenal research tool for everything you need to know. It has all of the company statistics right here on the front page. But the great thing is when you go into their financials, you can make very simple charts. Tells you everything you need to know about a company. And they have these great KPIs, so key performance indicators. So with a company like Shift4, which I'm going to talk about, end-to-end payment volume, payments-based revenue, what's subscription-based revenue? That's going to be viewed a little bit differently than payments-based revenues. All these things are easy to find. You can even find transcripts and just listen to them while you're doing your research. Phenomenal tool for fundamental investors. And you can get 2 weeks for free if you go to fiscal.ai/ASYM. After that, they'll give you 15% off if you decide to become a paid user. So let's go to Fiscal AI and look at Shift4. And this is one that's been on my radar for quite a while, but the recent drop in the stock, over 50% off from its high, has made the valuation much more palatable. $4.8 billion market cap. There is about $4 billion worth of debt on the balance sheet. So the enterprise value is just below $10 billion. But look at this. Price to earnings multiple on a forward basis is just 11. And the price to free cash flow is just 7.7. So that's when you're starting to get into this value territory. And for a company that over the past 5 years has grown revenue at a compound annual rate of about 39%, that can be a really good asymmetric opportunity. So let's first of all look at the revenue trends, and then I pulled operating profit here. So this is going to give you an indication of how much profit is coming from the business. It's going to take out a little bit of the volatility that you get in net income, but it is going to include those operating costs. So total revenue has grown 33%, and they've got a lot of operating leverage now pulling into the business with $309 million in operating profit over the past year. Now, a lot of their growth is non-organic growth, so they're acquiring growth. That's why you do see a significant amount of debt on the balance sheet. So cash is going to be here in blue, and then debt is going to be the purple and orange columns here, over $4 billion in debt today. Well, what I like about Shift4 is that this is much more of a niche player than they seem. So they're going to be operating in places like stadiums, in luxury retail, hospitality. They're the number 2 market position in restaurants. So those are going to be areas where it's going to be much harder for competitors to come in and offer a bespoke solution, which is really what Shift4 is doing in a lot of these places. A stadium doesn't necessarily need the same tools as a salon. So it's not a one-size-fits-all market, and they're basically creating these verticals where they're able to dominate that vertical. And that's going to increase the subscription revenue and the payment volume that's going through the business. There is a lot of competition in the payment space, but when you're getting companies like this for a really good valuation, I think the upside is really there for Shift4. So not yet in the asymmetric portfolio, but definitely one that's on my watch list in 2026. Another one that I've been watching for a while is the Trade Desk. The Trade Desk once had a stock price in excess of $139 per share. That is down to about $25 per share. So about an 80% drop in total. But that's given us a pretty good valuation for the stock. Let's just look at the forward numbers. Price to earnings multiple is 12.4. Price to free cash flow is 14. This is phenomenal value for a growth company if they're able to continue growing. That's going to be the question for the company. 5-year growth rate, 31% compound annual growth rate, 3 years, 23.5%. And really the question for the Trade Desk right now is, what is their growth rate going to be long term? Is this going to be a company that's going to grow in excess of 20%, or is this slowdown over the past couple of quarters indicative of a slowdown and more competition coming into the business? Now, remember, the Trade Desk is going to be competing with companies like Amazon, Google, Meta. These are bigger tech platforms that have their own walled gardens. They're going to try to be kind of that independent player connecting supply with demand in the advertising space. But is that just too competitive a market to continue growing at a really high rate and doing so profitably? That's what the market is trying to grapple with. But again, the asymmetric opportunity is this is actually a company that's going to be able to grow in excess of 20% over the next 5 years. And now we're getting it for a relatively good valuation. One of the trends that I like to look at is what's going on with operating income. Are you getting operating leverage out of a business? And so despite all of the negative sentiment around the Trade Desk, what you're actually seeing in the numbers right now is that growth is pretty consistent. and you have an increasing operating margin. So that operating margin is now 18.9% over the past 12 months. These are all trailing 12-month numbers. So it's kind of smoothed out those numbers from the quarterly numbers I showed earlier. And you're seeing this operating profit continue to go. That's exactly what you want to see from the trade desk. Now, there is uncertainty around the business. Are they going to be able to grow in the future? I think the market is obviously getting bigger, but are they going to play the dominant role that they have over the past 5 years or so? That's really what investors are questioning. I think there's reasons to think that there's plenty of business out there for a lot of different players in advertising. The trade desk will be one of those key operators. Some of these operational hiccups that they've gone through, some of the slowdown in growth, probably a little bit of a learning experience for management there. But the risk reward now is much more attractive than it was when the stock was quadruple the price that it's trading for today. That's why I think the risk reward profile here is just really attractive for investors. This is still a growth company, but it's trading for a pretty good valuation. If they decide to, they could go out and buy a significant amount of their stock, $1.4 billion worth of cash on the balance sheet, on top of the operating cash that's coming in, could buy back 10% of their shares outstanding just with that stock, the cash that's already in the balance sheet. So a lot of optionality for the trade desk. We need to watch those operating trends over the next few years, but I think the valuation, the risk reward, much more attractive today than it has been in a very long time. Another one that I do own in the asymmetric portfolio is MGM Resorts. And the thesis has always been here that this is a phenomenal cash flow business. It's a supply constrained environment. You can't just walk into Las Vegas or Macau and build a casino. So these are going to be cash flow machines. It's basically like having an ATM on the Las Vegas Strip or in Macau in regional casinos. And those businesses are growing over time. You see, there's obviously a huge blip during the pandemic, but over the past 10 years, compound annual growth rate is about 7% for MGM Resorts overall. And that's despite the fact that Macau's still not back to where it was about a decade ago. But one of the things I like is the business today. I'm going to get to their growth opportunities in the future, but their business today is a high cash flow business. Over the past 12 months, $1.46 billion worth of free cash flow coming into MGM Resorts. They have spent a vast majority of that on buying back shares of their stock. $1.2 billion of shares repurchased, and that's on a market cap of just $9.5 billion. And here's what's happened to their weighted average shares outstanding over the past 10 years or so. Let's look at this. Let's look at this on a quarterly basis, and you can see that quarter after quarter, there's just a consistent reduction. The compound annual growth rate is a negative 11.6%. That actually picked up in the most recent quarter as they got a little bit more aggressive with their buybacks. I think they're going to do that again in 2026. But there are two things investors need to know about this company that's trading at a really good valuation. There's upside from online gaming. So BetMGM, their business continues to improve. Total EBITDA for fiscal 2025 was $220 million. That was up from $71 million a year ago. And MGM's wholly owned digital business, so that is outside of BetMGM in the US, which they own 50% of. These businesses are just now starting to get to the point where they're generating positive free cash flow. In the most recent quarter, they got a $135 million check from BetMGM. That's probably going to be coming from not only BetMGM, but also some of their digital properties around the world in the future. Where there's huge upside for MGM is when MGM Japan opens in 2030. That's only 4 years from now. This could be the most profitable resort when it opens, generating over $2 billion a year in adjusted EBITDA or cash flow coming from that business. MGM is going to own about 44% of that property. So that could be another around $1 billion worth of cash flow that's going to be coming just from this single resort. They do have to invest a little bit more money, but a lot of their funding is going to be provided by debt. So that's a ton of upside for MGM, and you're getting the stock today at a really, really good valuation. So I think if you're looking for values in the market today where there's asymmetric upside, companies like Shift4, the Trade Desk, and MGM Resorts are at the top of my list. I only own one of those in the asymmetric portfolio, but the other two absolutely on my watch list right now. We'll see how their operations go over the next few months, but they definitely have potential because of those low valuations and high growth rates if the market sentiment around them turns around. But let me know what you think is an opportunity in today's market. Leave your comments in the comment section below. And don't forget to subscribe to Asymmetric Investing, not only here, but also the newsletter. Thanks for watching, everybody. See you here next time.